Why banks say no to people who are actually wealthy. One of the weirdest things about the mortgage world is sometimes the people getting declined are actually financially stronger than the people getting approved. And if you're self-employed or a real estate investor, you probably already know exactly what I'm talking about. Hey guys, this is Sal Bossio with Mortgage Universe on YouTube. I can't even tell you how many conversations I've had with business owners making serious money, sitting on huge reserves, owning multiple assets, excellent credit, and they're completely shocked when a bank tells them, sorry, you don't qualify. Meanwhile, somebody with one stable W-2 job and way less overall wealth gets approved easily. And the reality is this confuses a lot of people because from the outside looking in, it feels completely backwards. I was talking to a borrower recently, successful business owner, great credit, multiple properties, hundreds of thousands in liquidity, genuinely financially strong. And the first thing he says to me is, yeah, I probably need some kind of no-doc loan. So I asked him why. And he goes, well, I'm self-employed. I write a ton off. Dealing with my CPA is a nightmare. My tax returns probably don't look great. So I said, okay, that's exactly when it really hit me how financially successful people still don't realize products like DSCR loans even exist. Because this guy automatically assumed the only path available was traditional conventional financing or a straight up hard money or private money loan. So for him, he's thinking tax returns, strict DTI calculations, income limitations, all the usual stuff. And that's what's interesting is this is exactly the type of borrower many DSCR lenders actually like. Strong credit, strong reserves, investment mindset, financial experience. But because he structured his taxes efficiently, he assumed scaling real estate was going to become harder and harder every year. And to be fair, with conventional financing, eventually that can happen. Your DTI tightens, your taxable income gets compressed, you accumulate more financed properties. Eventually it starts feeling like you're trying to sprint while dragging a parachute behind you. And this is where the entire DSCR conversation changes. Because with DSCR loans, the lender is primarily focused on whether the property itself cash flows. That's the shift that most investors still don't fully understand. Instead of obsessing over your personal income and debts, the lender is asking, well, does this investment property generate enough income to support the debt, meaning to support whatever the mortgage payment is going to be? That's why rental income matters so much. The property itself starts becoming part of the qualification strategy. It is the qualification strategy. And once investors understand that concept, it's almost like somebody finally hands them the actual blueprint for scaling. Because now instead of constantly worrying, well, my personal debt to income ratio killed this deal, the conversation becomes, does this investment actually perform? That's a completely different framework. And by the way, if you are into conversations like this, DSCR loans, real estate investing, scaling rental portfolios, leverage, how lending actually works behind the scenes, definitely follow, like, and subscribe because I'm going to be diving way more into this. Because I genuinely think that we're still early in the entire DSCR space. Now, obviously, these loans still have underwriting. This isn't some fantasy easy money loophole like social media sometimes makes it sound. Credit matters, reserves matter, property quality matters, cash flow matters. But the underwriting framework shifts more towards the asset instead of purely your personal income. And here's the part most people miss. Traditional underwriting isn't necessarily trying to determine whether you're wealthy. It's trying to determine whether your income is stable, predictable, consistent, and easy to document. That's a completely different thing. So somebody can have millions in assets, strong cash flow, profitable businesses, investment properties, excellent credit, and still create challenges in traditional underwriting because the income structure itself is complicated. That's why DSCR lending exploded. Because eventually lenders realized modern investors don't always fit neatly inside traditional underwriting boxes anymore. And another thing most investors completely underestimate is how different DSCR lenders are from one another. One lender may love short-term rentals, another may hate them completely. One lender may allow lower DSCR ratios, another may require stronger reserves. Some allow LLC ownership, etc. It's almost like every lender has a different personality or risk appetite. That's why understanding the lender side of investing is such a massive advantage, because sometimes the difference between getting declined and getting approved has nothing to do with the borrower being weak. It's simply the wrong structure or the wrong lender for that scenario. And what's crazy is there are investors out there scaling portfolios incredibly fast with these products, while a huge percentage of people don't know about them and still think conventional financing is the only path available. The bigger shift happening here is really about the economy itself changing. More entrepreneurs, more self-employed income, more investors, more non-traditional financial situations. Traditional underwriting isn't always fit modern wealth building anymore. Or, I'm sorry, traditional underwriting doesn't always fit modern wealth building anymore. And DSCR lending evolved directly out of that reality. So that's why I keep saying DSCR loans are not just another mortgage product. They're becoming one of the most important scaling tools modern investors actually have available now. And the people who truly understand how leveraging these products work, or how to leverage these products strategically over the next decade, are probably going to have a massive advantage.